just looking at their stock price, and I glanced at what the numbers were. Loans stood out. Obviously, the stock price stood out, and off my cuff, I would say, yeah, probably forward earnings, and they disappointed in the widget. You know the widget, right? Every company's got a widget, a thing that everybody looks for. With Apple, it's, you know, phone sales. With Facebook, it's uh, sign up. Netflix, it's subscribers. There's always a widget. Just to remind you guys, by the end of the month, we'll probably not be using Zoom anymore. I'm either going to be using Google Meets or just do it all from YouTube. Plenty of warnings, so everybody's got an idea that it's not going to be a surprise. All right, I think I got it all up and running. Yeah, that's absolutely right. But look back farther to your left, that other really big candle from Wednesday. Uh, there's the red one almost right in the middle of your chart, and then there's a green one farther back, closer to the left side of your chart. Good morning, everybody. It's Friday, and I have to say, for a moment there, kinda I had to look at the calendar to make sure it actually was Friday. It does not feel like Friday. What a week. It just went by so fast. But we've had some really good trades this week. The markets were generous. Japan is still down 2%. Um, this is starting to be a theme. Sell the rumor, buy the news, or buy the rumor, sell the news. They're getting whacked, continuing to get whacked. You can look at the Nikkei, even on Thinkorswim, just type it in. You can do a search, try to find it. But on TradingView, finding foreign markets is certainly a lot easier to do. Behind Japan, we've got the NASDAQ down 0.5%, with the Russell behind that, and then the S&P, and then the Dow all down. Hong Kong down 0.25%, and then Europe up. There are going to be some European speakers today. We're going to get some data from that direction. But you can see on the schedule, we really don't have that much. And I get it, consumer sentiment, it's not to be ignored, but I mean, they're hedging this morning, and we're seeing some significant moves. There's a lot of cumulative divergence, though, right? Looking at the cumulative delta here, we were in a bullish divergence on that low, and I'm still in it right now. I'm not normally in while I'm streaming, but I like this. This is a bear pennant. and I have a trade called the failed flag play. I love this setup. Couldn't resist. So the lower portion of this chart is cumulative delta, and it was showing that there was bullish divergence here. You can see how the ES, this is a 5-minute chart on the right side of my screen. The ES had fallen down, and then we had a liquidity gap here. At the very least, we expect to come back up and get this gap closed at 52.32 cog line. I would front run that a little bit, right? Be prepared to get out somewhere around 52.30-ish, right around in there, unless you want to be precise and try to run it up to 32. 32 is a cog line. But in that fall, starting way back here, we still had cumulative delta move into the upside. It's very bullish. And then, of course, we fell out here. So we got the fallout on the cumulative delta, but it came back to this low. Price just really fell out. Lowest level on the session. So very divergent. Couldn't resist. Got to get a little. So we got a lot of Fed speakers today. We're going to see export prices. We've got consumer sentiment, and it's exactly like it sounds. It's a report. It's a survey. They're asking people, how do you feel? You all warm and fuzzy? Does it tickle? But there's still a lot of hedging going on. And it's the one with the red box showing that it has a history of being impactful. We want to be aware of the trading activity. If they're spending money to hedge this morning, then they're worried. That's it. We don't have to understand it or even agree with it. We just have to, recognize that that's what they're doing. Looking at it on Thinkorswim, we just have these 3 data points, 8:30, 10 o'clock, 1 o'clock. I'm really hoping that this afternoon is going to be fair game. So, kind of rewind here for a minute, back up. What do we got this afternoon? Just some Fed speakers chipping their teeth. That's it. But that could be enough. That could certainly put us in a hurry up and wait scenario where we go into the end of the week just trying to hold what we have. That'd be a boring Friday if that's what we get. And there's no reason to reach, right? If that's what we have, call it early and go get some cookies or something. We did already hit the lower ADR, which opens us up to hit the upper ADR by the end of the day. That would be 52.71. We also hit the 0 gamma, maybe not perfectly, but we would call that close enough. And we have the volatility trigger overhead, which tried to act as a support level, which means it will now also try to act as a resistance level. Just keep in mind, support and resistance is a very generic concept. We want to watch the price action at that level. Is it being resisted? We can see pulling and stacking on the dome. We can watch the order flow. And if you're using something more advanced like Bookmap, Jigsaw, you can see reconstructed order flow so that they can identify if a bunch of small trades are actually part of a sweep or a block. That does line up with VWAP, by the way. That's what that dashed line is. We could get a little bit of reciprocation. It's just the concept that if we overshoot and expand really far on one side of VWAP, that we will very often expand and stretch on the other side of VWAP. Call it a zipper trade. We've got a lot of moving averages all stacked up there together. The 10-day, the 3-week, the 20-day. We are interacting with the daily pivot point right now, so we don't have an MDP, and we're still holding underneath the weekly pivot point. Now, these weekly pivot points are often insightful, right? Where we're at, above it, below it. for almost this entire week, we've been hovering around it, cutting up and down below it. We've expanded beyond it a few times, but we just keep coming back to that level. So it's acting as a really good gauge of sentiment structure. We've got to get beyond this. Now, there's a lot of negative going on out there. I mean, look around, everybody's calling, oh, we're at highs, we're at the tops. It's so top heavy, we're extended, overbought, all these phrases that make you think that we got to turn around and fall. And I'm not necessarily disagreeing with them. Just I've seen so many times where they get you all bared up, where you're convinced we're going down, and then some bit of data comes out, they do a rug pull, and we leg up into a whole new zone. Throughout history, we tend to rally out of situations like this way more than we fall in the indexes. That's how the indexes got to 5260 when it used to be 2860. I'm relatively new to the trading world, all things considered. I haven't been doing this for a decade, but I remember trading 5260, 2860. Wasn't that long ago. I think that they're certainly in play. Absolutely. There's a lot of liquidity gaps, right? So the one that stands out is Wednesdays for sure. But that lines up right with our ADR. So it's just whether we say it's the liquidity gap or whether we say it's today's ADR, either way, it's the same target. So I'm cool with that for sure. Um, the problem is the hedge. They're hedging. They're hedging and they're trading. Normally we get one or the other, right? They will get out and they will uh, sit on the sidelines and hedge, or they'll participate and they don't hedge. Today we're getting both. They are trading and they are hedging. So that's a little bit of a concern. There's a lot of bullishness if we come back, to this cumulative delta. There's a lot of buying going on, which accounts for the volume we're seeing. But they're still loaded with a hedge. If we could just set all that aside and look at our ADR levels individually, just that, or in isolation, we've hit the lower ADR early in the morning, and statistically that says we can now hit the upper ADR. We can take that all by itself. The hedge doesn't give us direction, so that's not helpful on trying to decide whether we can get up here or not. And this cumulative delta that's very bullish, that tells us that we can go to this upper edge. So what else do we have that's showing us negativity? Nothing really, not yet. 10-day, 30-minute volume profile. Wednesday's gap certainly stands out. Last Thursday's gap is the one above that, right at the round number. So we could say we're focused on the liquidity gap, or we could say we're focused on the round number, either one, because it gets us to the same goal. And if we were to measure, say, this event candle, I'm almost positive that it would give us a level here at 5,300. So whether that is a 111 warning center or a 1236, I'm pretty sure it would be a 111 warning center, but it would still be another pivot that lines up with the round number. So get this gap filled, get that gap filled, then we'll focus on the high of last week, or maybe even the high of the week before this point. We still have that point of control to deal with, 5250. Don't get hung up on, that last number there. It's 5254, but really it's 5250, but liquidity resides on the other side of the pivot. The pivot is 50. Liquidity was at 54. We want to focus on getting back to 50. one step at a time, right? It's kind of like milestones. Get to one, focus on the next one. Right now, we've got a minor gap close that we have to do. So back up here to 32 or 34 cog line, then to the point of control, 5250, then to this gap close, then to this gap close, get past this high here. That would be another one. And that's all it is, step by step by step. We have no shape here, by the way, unless we want to develop a new one and call it the crown, right? And think of a king's crown. We'll flip that on its side. There's our crown. But there's not a crown in the profiles. It's usually P, B, D, B. We don't have any of those. We've still got 70% of all of the volume in this zone. So between Wednesdays, call it Wednesdays RTH, that's where 70% of all the volume is over the last 10 days. It's all right there. We were working on a really tight range. And it's too bad that it broke before, we all really started to get into this. But I mean, that's fantastic. You got to look at that as textbook, perfect example of a really tight IB, the initial balance, what they teach with the when you go and study initial balance and open range is that's exactly what you're looking for. And there's so many times where it's not quite as good as this, and we use it anyways, but that is a very narrow overnight range. And at 2 o'clock, there's a kill zone between 2 and 4. I don't know why they call it that. I don't name these things, but the name always stuck with me. Between 2 and 4, statistically and historically, is where the biggest moves in the market happen in a 2-hour time frame. So you can take a 2-hour time anywhere in the trading day, say from 9:30 to 11:30 or from 2 to 4 p.m. Take any 2-hour time frame in the entire trading day, and you won't find bigger moves than you will between 2 a.m. and 4 a.m. statistically and historically. But this 2 a.m. between 2 and 4, we didn't do anything. And that's kind of odd on its own. That's a little rare. I mean, we don't have to get big moves, but we almost always do get some kind of move in there. We got nothing this morning. The big move happened after all of that. And the cumulative delta said stay bullish through the whole thing. So once we started to build that bearish pennant, knew what the play was. Sorry, I had to get out of my position. We've already got next week's range. Now, this range is not set in stone. These lines are still moving. They're connected with price, which is where we are right here on this gray line. And all three of these lines are moving in sync. They're all three moving up, and they're moving down as price moves. The distance between the red and green line is derived from math using volatility. So if we come in here for a minute, we look at next week's options. It's 89 points higher or 89 points lower. But It's not set in stone yet. We need to go into the weekend. So at 4:15 tonight, we'll call it quits. And whatever that number is, that'll be the weekly range. So if you're not using Thinkorswim and you don't have this indicator that will draw those lines for you, it's okay. You can do it on your own, but you have to do it over the weekend. You can't do it early, and you can't do it Monday or Sunday night. It'll be too late. So sometime after 4:15 and sometime before Sunday morning, even Sunday, maybe Sunday afternoon. Just don't wait too late in the day on Sunday. You can draw those levels out for yourself. Mobius developed that indicator for for an old school trader. This old school trader is the guy that helped develop what we're looking at right now, this Thinkorswim platform on the options tab and all of these options tools that went with it. So very smart guy. But he was hand drawing those levels every week. And Mobius said, well, we can do better than that, because what if you want those levels on Apple on Tuesday, but you didn't mark it down last Friday? Then now what are you going to do? Wouldn't it be nice to just have an indicator that would do it for you? The problem is, and why I'm mentioning it, is the indicator actually can't read this. We can't code things on Thinkorswim that will read this. So he had to come up with some funny math to get this number on his own. It's not as accurate as if you drew it by hand, if you went in there and got the numbers for yourself. So if you use a skewed tool every time, then the skew is the normal answer. It's like tracing something that has a nick in it. Every time you hit that nick, it's always there. It's just a part of what you do, right? It's like a character. So don't jump back and forth. If you want to do it manually, do it manually. If you want to use the indicator, use the indicator, but don't do it one way and then the other week another way. So on Fridays, we get a chance to measure next week's volatility and compare it with this week's current week. It's not perfect since the new box is not set in stone yet, but we can see where's their head at. Are they pricing in more volatility for next week or not? And at the moment, they are. They're actually pricing in a little bit more volatility than we had this week. What is on the deck next week that could cause us to have even more volatility than we have this week? We are kicking off earnings season, and that has to be taken into account. It's one of the things that everybody keeps pointing to when they say, are we going to get a rate cut? Well, has the 1 year of sitting at this, mildly restrictive territory, has that actually caused, has there been an effect from a cause and effect point of view? Is it actually impacting companies? Is it restrictive at all? Because if it's not, then the argument that they need to continue to raise rates starts to bubble back up. Remember, there's no consensus on what the neutral rate is. That mythical unicorn, this hypothetical level of neutral rates. Well, if you don't know where neutral is, how do you know you went past neutral into mildly restrictive territory? The Fed's been saying, we're there. Just got to wait and let it present itself, that it's a lagging effect. It's going to take time for the rates that they already raised to work its way through the system and to have an effect. And they don't want to over tighten, because by the time they found out that they had over tightened, it would already be too late because of that lagging effect. We're going to see through this earnings cycle whether or not the Fed needs to tighten more, or if they're actually getting anything for all their hard work and for raising rates. Maybe that's a little bit, that couldn't be enough, right? So that sends us back to looking at the calendar, thinking about next week. What else is on the table? We know it's not FOMC. It's not QRA, right? So Those two are off the table. It's not the non-farm payrolls. Well, with that door, uh, I personally see more value in the door and the 3-day open range, whichever one you like. I see it having more value on equities. And I've actually had plays out of it. I've had trades, I've had setups on equities because of it. When it comes to the futures, I haven't seen a lot of value out of it. And I went back 4 years on the S&P and the NASDAQ trying to find really good, viable, recognizable setups from it. And they were all about as good as a coin toss. And I can do better than a coin toss with all my other tools. So I didn't really find a lot of value on the door for the futures. But if we're going to use the door like an open range, as soon as we're outside of that open range, either to the upside or the downside, then we play that direction. So we're underneath the door. We would stay bearish as long as we're underneath the door. We would have to come back inside the range to just get back to neutral, and then we'd have to break to the upside to find a long. I'm disappointed in the door when it comes to the futures. I thought there would be more to it, but it wasn't meant for the futures. Not that that's ever stopped me from trying anyways. The market maker move that we use to identify when they're hedging, they never use that for futures. So when I started using it on the futures, it was kind of, taking chances and just seeing what we can get out of it. Not willing to stay confined in a box that says we don't use that for futures. So when it came to the door, it was kind of the same thing. I thought, well, it's worth a try. Maybe we'll get something out of it, but no. Never know until you try, though, right? So with the door, it's about as useful for the futures as the weekly pivot point. When we look at that weekly pivot, we're bearish below, bullish above. It's just like the anchored VWAP. Anchored VWAP is fantastic. I mean, it's an amazing concept. And uh, on the futures, depending on where you anchor, it has a lot of value. But the new contract, which to me made perfect sense. Why not anchor on a new contract? Completely worthless, had no value whatsoever. Never know until you try. It really looks like they brought the put wall up pretty close to 52. So we're getting a lot of our options levels all tightened up here together. They didn't have the AM shared yet or posted yet, so I couldn't share it. When we get the AM, we really want to reevaluate the founder's note from Spot Gamma. And yeah, it's out now. I'll get it shared in a minute. But we want to see if they write anything up about the put wall. Usually when we get a big shift in these options levels, they do a really good job of pointing them out and talking about what it means going forward. So rather than me speaking out of turn, I'd rather see what they have to say and follow up with it. But first blush, seeing all three of these levels right at price and us holding the line like this, how we have, to me, it feels very bullish. There's the 10-week we've been talking about, that we do talk about all the time. And speaking of the weekly expected move, I didn't really finish up on this. We're under the 20. We're above the 50. That puts us in a pinch pattern, kind of like a squeeze, but these aren't the indicators that you would use for a squeeze. We're holding in the lower portion of this week's expected move. If we can get some push today, we could get through the Friday close, which is a pivot point all on its own. It's a weekly close, so a major pivot point. We can get through the 20, challenge all these sellers here, and push up into that 5,300. Even today, it's not off the table. This is a daily 50 reset, right? Like a daily 50 bounce. It's a really good setup. The thing about bouncing on a moving average or bouncing on anything really is that a lot of times if it's negative, it'll bounce once and then it'll break. Not even just once. I've got a 1, 2, 3 fail play that works really nice. But the point is it'll find support, but it'll continue to head to the downside. So we don't look at moving averages as support and resistance by themselves. We just want to see the effects, see all the buyers stepping in there. It showed they defended that level. And it's a bit of a reset. So if this is going to be our spot where we reset, regroup, find examples in the past where we were riding well above the 50, came back and got a reset, had a little bit of a digestion, multiple resets with really a lot of chopping sideways, and we finally started to run again. Then a couple of resets, we started to run again. .5% above the 10-week. We haven't started to curl back and go the other direction yet. We're still just heading to the downside. So, you know, are we going to get all the way down there and actually get below it on the weekly? Or are we just going to get near it and then move back away from it again? This doesn't give us that answer. Just kind of points us in the right direction, helps us with volatility. We can see all of our options levels on this 5-minute. So it's been a while, right? That put wall's been low, usually a lot lower. We have to like, you know, scrunch everything together and look way down here to try to find it. And right now we don't. So they brought that put wall up. I'm going to read that as bullish, but I would encourage everybody to read the founder's note when I post it. And I'll post it when we're done with this stream. Because I'm pretty sure they're going to talk about these levels and give us their interpretation. We did get the gap closed on that liquidity gap. So it was just a minor one. But still, I love showing these examples. This is what we want to focus on. When you get a setup like that, why not take it, right? That's what I did this morning. Why not take it? We came down into the ADR. We could see the buyers trying to defend this level. We already had a destination in mind. It was a cog line and it was a gap close level. Perfect. Load up with 10 or 12 contracts, get it done, and do something else for the rest of the day. No reason to nickel and dime it with 1 or 2 contracts for 2 or 3 points and again and again and again all day long. The hedge is not really too big yet, but it's big enough, right? If you think about our average daily range being 1%, actually a little over 1%, this is almost half of our daily range. So if you don't have an ADR indicator, don't have these numbers, you can draw a line 1.5% away from where we opened in Globex in each direction. and that would give you your target for an outsized move. Really don't have a reason to expect an outsized move today, though, right? That's the thing we keep coming back to. Things that are down this morning, the China ADRs through the K-Web, nat gas, more China stuff, semiconductors, and that's it. We can see that tech is down a little, but not down enough to meet our criteria. SPY, financials through KRE, through XLF, those are all down, but not enough. So we don't put them in the down category until they're down at least 0.5%. For things that are up, gold, gold miners, gold passed 23, was it 24 last night? I don't know. It's certainly time to take some off. $24. Goodness. Probably want to lighten that one up a little bit. And if you're trading futures, remember you can trade gold futures, especially on days when the ES and the NASDAQ are choppy and nasty. But we got precious metals, Bitcoin, bonds, which bonds are probably a reflexive bounce, more Bitcoin, and that's it. We can see metals and mining is up, just not enough. Same with energy, uranium up, but not enough. Things like SHI, maybe TIPS might get a bit of a move today. HYG, all bond stuff, they're just not up enough yet. So if we're looking for one of those days where the market just rips and gets it, we want to see more of the FANGs, the Apple, Microsoft, Google, Amazon, all of those kind of things making moves to the upside, financials to the upside. Those would be where we would expect to have that continuation, that carry to the up. We don't want a market rallying on hot stocks and Bitcoin, right? That's not what we want. That's not a sustainable rally. Rising tide lifts all boats scenario. So we want the advanced decline line in the high 80s, maybe in the 90s, more money coming in than out. And the names that are making those moves to the upside to be a part of consumer discretionary, technology, and financials. Those are the risk on sectors. This is the grid that I tend to use. You can just take a screenshot of that and rebuild it. I have shared this chart, shared every chart that I use in the morning briefing in the YouTube description, and they're in the Thinkorswim workbook. But I know not everybody uses Thinkorswim, so you could just rebuild this. The top three is risk on. When we're bullish, we want to see these sectors do good. When we're bearish, we expect these sectors to do good. And the three in the middle are midline. In the bigger picture for like a swing trade thing, the idea would be, you know, in a good economy, these top three would be your go-to. In a bad economy, these bottom three would be your go-to. And in a good or bad economy, these three in the middle would still tend to do reasonably well. Energy, everybody's going to run their AC in the summer, their heater in the winter. It doesn't matter what the economy is doing. You still want heat and AC. Building materials, big construction jobs of building a building, you know, in a major city. They don't just call time out when the economy gets bad. And industrials, healthcare, utilities, staples, those defensive plays tend to be left on the back burner when people are, you know, speculative and willing to take risk. This isn't really a representation of risk, right? Buying Campbell's soup or Kellogg's, grocery stores doesn't really scream risk taking. But for the intraday, we need more than Bitcoin and we need more than bonds. Bonds is a good start. We want to see the 10-year down. We want to see, the dollar index going down. And we've got the 10-year. We do have that. We're challenging yesterday's low, but we don't have the dollar moving to the downside. And this would be one of the things. If we're going to really rip to the upside today, we want that. We want to see that dollar get back inside of yesterday's range first, and then break the bottom of yesterday's range and challenge Wednesday's low. We get that kind of move, we could have the ES at 5,300 by the end of the day. Right now, we can't even seem to get past VWAP, but this is a perfect setup for reciprocation. So to just measure the deepest point of this move, take that bar and set it on the other side. That's a soft target. At the very least, zipper play. We're seeing US dollar Japan back off a little bit, which is really good. It needs to back off a lot more. You can see how we're getting these higher lows. We don't know if we're going to get a higher low here. So, breaking this low, and that's a long ways off, just call it 53. Let's get below 53 first. It's a nice benchmark. If we can get through that, then we'll focus on the 10-day moving average. But that white line right there, that's a 3-day moving average. It's really bullish when we cut above back here. We've been holding it, had a nice run. We can dip below it. We dipped below it back here, but we got to close below it. We don't have that. So let's break 153. We get that. We can aim for the 10. We want to see the US 10 break this low, really expand to the downside, and the dollar needs to get in line. China, nat gas, cloud services, emerging markets, which is China again, and tech now is down enough that we can call tech too, because it's down 0.5%. But it is trying to pop back up again. Silver, gold miners, pot stocks, more gold, oil or crude, bonds, Bitcoin, UUP, which is the dollar again. I say the Dixie is the dollar, but really it's just the dollar index. So things have got to change. This isn't enough. This is the homemade NY Fang, that little homemade ticker that we use. It's got Google, Microsoft, Apple, Nvidia, Facebook, Tesla. It's got all of it, right? This is our homemade ETF. The reason we make this is because it works in the pre-market. But if we was to go to the NY Fang, that thing doesn't start moving until the open. we can see it's down in the pre-market. So if we don't have the fangs, we don't have any hope of a real rally today. And copper's up as a part of those precious metals. Copper's up this morning over 1%. Puts us in a really nice position. Not blue skies, but still looking really good. This is a daily chart on crude. You can see how we're forming like a bullish pennant. The thing is, I don't like bullish pennants. Um, just like bearish pennants tend to break to the upside, this has more chances of breaking to the downside than it does the upside. I like all these buyers coming in and defending this low. Let's just zoom in so we can see that 85.5. There's 85.5 right there. So we can see all these wicks down here, how they defended that low really well. But all these sellers across the top, we set that peak. We haven't been able to get back to it. If we were using OCR, we've continued to get lower highs, lower highs, lower highs. Now, in the last few days, we've had these higher lows, and we had that higher high here with a higher close or a lower close. So that's what are they in OCR? They call this a change candle or a warning candle. But just using these last 3 days, higher lows, conflicting highs, this is forming a compression like a squeeze. On this time frame, if I put a squeeze indicator on it, you wouldn't see a squeeze here, but it is price forming a compression. So a big move is winding up. There's no directional bias to that, though. When we zoom out and start putting it in context with a bigger picture, it's been a long time since we've come out of these lows. We can come all the way back to 2022. We're still in the same zone. So, we're talking about a fundamental change to get us out of this box. What's the reason? What's the change that would get us out of this? Election year. We know that that's a gimmick that every presidency does, keep energy costs down. They just had another announcement from this administration trying to limit drilling in Alaska. What's that going to do? We just got the EIA report, but I spent most of the day yesterday in the hospital, so I didn't read it. I went and seen the baby. Are we done refilling the strategic petroleum reserves or not? That has to be taken into consideration. There's so many parts and pieces that go into this that is not on the chart, right? All the behind the scenes stuff. If we're just looking at the chart, then we've got a rising wedge with a blow off top, and I would be looking for it to retest 80 and then give us that expansion to the downside. If we're just looking at price and not taking anything else into consideration. Let's see if this drawing tool can cover it even. No, it doesn't. We'll do it this way. There's the rising wedge. Rising wedges break to the downside, but sometimes they'll pop up first, give you that blow off top, and then they'll dump. Oh, so now Biden's getting in, huh? And pressuring them to cut rates. Thanks for that. I hadn't seen that yet. So now they're getting political pressure to cut rates too. And that probably goes back to Powell earlier in the year when he mentioned that one cut. Remember, he had mentioned one just for a GP that they were looking to cut at least once, not because of any of the data, more of just like a gimme. And then they took it back, like they walked it back. So we might hear more about that May 1st when we get QRA and FOMC. Looking at crude on the intraday, we're still inside of yesterday's price action. So we're inside day. We're beyond the half back. So we don't have any restrictions now until we get back to the top of yesterday. We don't even really have a zone here that we could measure to do any projections to the upside unless we wanted to measure the first 5-minute candle from Globex. So at this point, we would look at this, add the ADR to everything, and we would focus on getting to that ADR first, then getting to yesterday's high second, and then breaking that, making moves to the upside, trying to get to the full ADR. But I would take this measured move of yesterday, add the 111 warning center, 86, 83, and then 87, then the full ADR up here. Remember, crude is $1,000 per point. So if you can go from 86.3 to 87.3, that's a nice move. There is a micro of this thing too, right? So if that number scares you, just consider using the smaller product. So that's what we've got, guys. We want to see more, right? This rising tide needs to lift some different boats. I would watch the fangs close because if we can get them on board, that would help. Otherwise, keep your eye on the news because they are hedging for a reason. And we want to see that news come through. Even if we don't know what it is, just the fact that we know they're hedging gives us that edge. I can tell you a lot of people have no idea how to even look to see if there's hedging going on. So you're above the crowd, right? Be careful, be safe, have a good weekend. I'll see you all Monday.